Gino Levrini has asked, can you make a video choosing the right time till expiration, and why don't you do options that expire in less than a week versus a month? All right. So there's a few implicit assumptions here, and we'll deal with them one by one. The main idea here is, how do you choose the correct option for whatever you're playing? Now let's look at a stock and make an assumption. Let's look at the VIX. And let's say you want to go long on the VIX. You think volatility is going to spike, and you don't want to put money in it because you know the VIX always goes down. And if you go ahead and outright buy this ETF, you will, as you'll see, you'll go broke. It went from 7K to $13. If you keep going long on this, you will go broke. However, once in a while, the VIX spikes. In this instance, it went from 1300 all the way to 2600, which would have, through an option, would have made you rich with one option. Now, if you're playing this strategy, one of the implicit assumptions here is that you're only buying a call option. You're not going with a complex strategy. So when you enter an options trade, you're not going with a strangle or a spread. You're just going with a pure option. That's the assumption here. I'm not recommending that, but I'm also not saying it's a bad strategy. It really depends on your thesis. So if your thesis is you want to play a non-linear risk reward profile where your risk is capped but your reward is not capped, then that's a fine strategy. But you have to deal with something that's really important, which is time decay. And that's the main determinant of your expiration date when you just play a long option strategy. Let's deal with the weekly idea first. So he asked me, why do I often see you playing long dated options when weeklies will do? Well, weeklies are great because they tend to be more liquid than monthlies. In other words, if you play with a weekly option, you have a higher open interest, higher total volume, so it's easier to get your order filled, and the spreads tend to be tighter. So it's just going to be better overall to play the weeklies in terms of convenience. But the problem with any change in expiration date, so let's say you go from July 15 to July 8, the problem with that is now your theta is bigger, but more importantly, your Vega is bigger. And the idea here is Vega, which you probably know, represents the rate at which that option decays. So if your Vega is, let's say, 5 cents, that means every day that you hold that option, the option's value goes down by $5. Now, we don't want that to happen, of course, but we can't avoid it. That's one of the characteristics of options. However, what we can do is we can make it so that theta is smaller, and perhaps more importantly, Vega is smaller. What Vega is the we'll just say, I don't want to use the word second derivative, but what Vega is the rate at which theta increases, right? We don't want a big theta, and as time goes by, theta changes. So maybe today we're losing $5 per day, but tomorrow theta changes, and now we're losing $6 per day, and then $7 per day, and it keeps increasing as we approach the expiration date. Now, Vega tells us how quickly that approach is, and unfortunately, eTrade Pro doesn't show us Vega, but you can just be sure that Vega increases more quickly the closer we get to our expiration date. So further is better. Ideally, we'd want to go out until infinity or a year, but the problem with that is we're going to be paying a lot of money through what's called the time premium. I'm going to add that to our list here. So you can see the time premium here is 0.5. We'll look at the VIX, and we'll just look at calls. Okay, put our time premium back there. Time premium. Alright, so we're looking at the VIX calls now, and these are the weeklies. these will expire at the end of the week. We don't have Vega in here, but we do have Theta. So here we are paying $3 or $4 per day to hold this option. Now if you look at the monthlies, you're paying less, right? You're paying $2 to $3. And if you go out even further, you can see Theta continually shrinks until you get far enough away to where Theta almost doesn't matter. It's almost zero. Now, the problem with that is you're probably not going to be monitoring this every day, and you're probably going to let the fact that Theta is now $3 but in 2 days will be $5 pass you by. For this purpose, if you plan on holding an option for a long time, you want to go with a longer expiration date, simply because you get a better Theta. You're less susceptible to time decay. However, once you go out there, you're going to realize that that time premium really jumps. So check it out. Here our price is $46 for this option, and the time premium eats all of that. So basically, we're only paying time premium. We're not getting anything in terms of intrinsic value. Now if you go out further, you'll see the time premium grows to where you're paying a lot more. In this instance, you're paying 4 times or 5 times the amount that you paid for the weekly option just for that time premium. Now obviously you don't care about the time premium if you're only going to be holding the option for a couple of days, but if you don't pay that time premium, your Theta is going to be bigger. So you got a trade-off here. Are you willing to pay extra in time premium to get a smaller Theta and therefore a higher ROI when you close the trade? That's the question. So the idea here is that if you go out far enough, you're going to be putting more capital up front for what is essentially the same trade, but you're going to have a higher ROI when you calculate it as the option price minus time premium as the denominator for that ROI calculation. So think of it as setting money aside almost as margin so that you don't have to deal with a high Theta value. And that's generally what I'll do. So let's say I want to make a day trade on the VIX. Fine, day trade, I'll go with the weeklies because they're cheap. I can buy a lot of them. I can get a lot of delta, which is really what you care about when you make a day trade. You really want a high delta, and you get a high delta for a really low price when you play the weeklies. Problem is you got a lot of time decay in there. Let's say I buy 10 of these contracts. Well, now I'm paying about $40 per day just to hold that strategy. So I generally like to go out a bit further, even if I'm day trading. Well, if I'm day trading, I'll do the weeklies because they're liquid, they're easy to close. I generally will close at the very, very end of the market, so that I don't want to be left holding an option overnight because I couldn't get it filled. Just because I couldn't get it filled forces me into a position I don't want, and in that case I care more about liquidity than anything. And you can check liquidity by looking at total volume and open interest, but total volume is generally a better indicator. Now if I'm doing a day trade, fine, weeklies are good because I want that liquidity. That's more important to me than anything. But if I'm going to hold an option for a week or a couple days, I'm going to move out. I'm going to double that expiration date. Now a lot of people think, okay, you double the expiration date, therefore the value of the option should be double. And you'll see that the price, if you actually look at the prices, yeah, that's generally true because you're doubling the time premium. However, subjectively, there's no math behind this, but subjectively, when you double the expiration date of your option, you get about 4 times the value. Because if you somehow gain momentum, let's say you're a momentum trader, this really applies more to momentum traders than anybody, but if you're a momentum trader, you can remain exposed to that momentum for longer than you initially planned if you don't see any sign of that momentum falling. And because a momentum trade is a nonlinear trade, and because options are a nonlinear trade, you've got a nonlinear vehicle on a nonlinear movement, and that's going to make you a shitload of money. And of course, in that situation, you want to be able to extend the trade. So that's why I say that a option that costs 2 times the price because you are going 2 times the time is actually worth 4 times in value, because you gain more exposure to momentum. Now, if you're not a momentum trader and you're doing something like mean reversion or statistical arbitrage, yeah, you don't need an expiration date that goes further. You don't really care so much about being able to extend your strategy. And if you have a very clear set time at which you're going to get out of your trade, then maybe you can go with a shorter expiration date. But the overall idea here is that if you can afford it, longer is better. You're paying less to hold it. And the only real downside is that in terms of that price, the price, of course, you're going to get back. The time premium you're going to get back. It's not going to decay that quickly. But the major downside of going with a longer expiration date is that they're not going to be so liquid. And if you're going to pick a weekly that's not the most current weekly, you're going to find that it's really not so liquid at all. There's only 300 to 900 or 5 to 900 in total volume for the middle 7 strike prices for this weekly option. But for the most current weekly option, you've got thousands in volume. So it's a liquidity versus theta decay question that you're asking here, and the answer is simply it depends on your type of trade. It depends on how long you plan to be in on that trade. It also depends on your capital. Do you have the extra capital to put aside some extra money in that time premium and then actually get more money out of the trade because you lost less in theta decay? It's really up to you. There's no one answer. The real answer to this question is, what is your thesis on whatever you're looking at, and how long do you plan to be in on that trade? Those two factors alone should tell you what your expiration should be. If you're a day trader, you should care more about liquidity and should therefore go with the weeklies. If you're a momentum trader, further is better. You should be willing to put up extra money in that time decay so that you can capture a longer momentum if needed. If you have a very clear exit point, I still say going with a longer expiration date is better because you're eating less in theta decay. But obviously, if you have like a price target and that's price target plus, let's say, an exit date, and you have a very clear strategy, for example, you think the VIX will hit 17 in 3 days. If you know where that's going to be in 3 days, then you can go ahead and go with whatever the cheapest is and maximize your delta value, because that's really all you care about. So I hope this video has helped you choose the correct expiration date for your option value, for your option contract. If it has, please like the video, subscribe for more videos of this type, and if you have a video request, leave it in the comments section below. Any questions would also be answered, provided you leave it down there. Alright,